What's going on, guys? It's the Bulls and the Bears back with a weekly game plan video with the wheel option strategy, of course, where I give you guys some names for this week and this week only to sell some cash secured puts on and start the wheel to generate that nice, juicy weekly income. So, this one was a tricky week, I'm not going to lie. This was not an easy one to find. I'm sticking with a couple names, some of which I'm not even that comfortable with. But we're just going to jump right into it. I'm going to start with DOCU. So here's DocuSign, here's the daily chart. If I can hide this 200 moving average, it'll make the chart look a lot better. So, first of all, I'm actually in this position. I just sold puts on it last week. I got assigned on both of them, and now I'm going to be holding 200 shares at an average price of $68.15 on Monday morning. And that's indicated by the blue dotted line. That's my cost basis. So I'm in this trade. I'm going to be owning DocuSign, so I have that laid out here. I have the cost basis line. I'm going to adjust that as I sell calls against it and whatnot. So it's an open position. However, I do think it's a very good play for the wheel, regardless of whether you have a position or not. I'm liking the 61 strike indicated by the yellow dotted line. That's the level I want to play. The vertical line is expiration date, so we just need to stay above the yellow line, the horizontal line, by the time it reaches the vertical line. That's how I like to draw it out. And now with a 61 strike, that's at a much better area of support. So I played the 68.15. I was pretty much playing, this is last week, played the 68.15. I was basically playing like the top here. I was looking for this prior resistance to become support. It didn't. It went through. But now we're playing with a much better area. Instead of looking for resistance to turn into support, I'm looking for support to stay support down here. Very nice area of support down here at $61 per share. I mean, that's pretty much as low as we got this recent stretch and back in June. If I go to the weekly chart, back the 61 dotted line, if I zoom in over here, you can see that it was pretty much support back here too. I mean, back in September of 2019, we held this area around $61 before ripping up and never looking back. I mean, we only went down below that level a couple times in the most recent month or two, back in June, July, and we didn't stay there that long. In fact, we actually created higher lows each time. You can see by this little uptrend here. So I'm going to draw that uptrend right now, actually, because I think it's a good, level to keep watch on, especially for me, because I'm actually holding 200 shares of it. So that means I'm going to be at risk of owning 300 shares by selling another put. I'm putting myself at risk for buying even more DocuSign, up to 300 shares. But at a price down here, I'm okay with that. I don't mind owning it anyway. And we have earnings coming up the following week, so that's only going to give me even more potential to sell covered call premium while the IV is really high. So that's going to be fine with me. I feel really good about this play anyway. I don't think I'll even get assigned. We have this nice trend line that would possibly give us some support. If it does break the trend line, we have the actual horizontal support as well at 61. So I like DocuSign here at $61. And the premium, by the way, if I just go to the other screen, it's looking to be about $70 per contract right now. I mean, when Monday opens and the gap happens, that could be different, more or less. But $70 right now, I'm happy with that. If we do gap down, I'll probably go for an even lower strike, maybe $60 if we gap down. I'll go to the 60 strike. Otherwise, I'm not going any higher than 61. I might go lower if we gap down, but if we gap up, I'm still going to try to take the 61 strike, even for a little bit less premium. But it pays 70 right now. So no matter what, I'm probably going to play it because it's going to be paying at least 50, I'm guessing. 50, 60, hopefully 70. The next name I'm looking at is right here. This is ZIM again. ZIM Integrated Shipping Services. It's the Israel shipping company. It's been doing very well, benefiting on high freight costs. I've been playing it a lot lately because it offers some solid premium. And now the premium is through the roof. If I go to ZIM on Webull, let me just bring it over here. So you can see all the puts here. I mean, at the money, he's paying $400. As far as $44 and as far as $5 out of the money, it's still paying $100 per contract. You go out even further, $7 out of the money is paying $40 to $50 premium. On a $40, $50 stock, like that's a lot. So whenever you see some abnormally high premium, because I've been watching this thing and I know this is abnormally large premium for puts. It's not earnings related, just had earnings. So what could it be? You got to look into anomalies like this, because I did look into it, and there's a dividend coming out, a very large one at that. I looked up ZIM, Integrated Shipping Services, just the name, and I found a headline saying it's paying an enormous 40% dividend, and the ex-date is this Friday. Looks like the gross dividend is about to be $4.75, which means, as we've learned as of late, the stock is probably going to drop, or is expected to drop, by $4.75 on Friday morning. So that's a big deal, and that's why the premiums are so high. I'm looking at the $42 strike because I want to go as far out of the money as I can while still getting a solid premium. The $42 strike's paying $40 right now, and I like that as a premium amount. However, and it's a $42 strike, 42, where indicated by that yellow line, at some nice area of support as well. But we're going to be like guaranteed to drop by $4.75. And that's on Friday. So on Friday morning, we should gap down by over $4 per share, which means if the stock were to drop by that right now, let's bring out the calculator. So the current price is $49.12. If we subtract the dividend from that, that'll bring us down to $44.37. So, and if we subtract our strike price of 42, that really only gives us $2.37 of wiggle room. Because if ZIM drops by $3, let's say, by Thursday, so it goes from $49.12, drops by $3, now it's at $46.12, and then on Friday morning drops by the dividend of $4.75, it's going to open at $41.37, which will put our put in the money and at risk of being assigned. So if ZIM drops by only $2.37 between now and Thursday at close, or Friday morning, then we're looking to be in the money and possibly assigned. I mean, this is a good area of support, so even if we do drop naturally, just from the intrinsic value of the shares with the dividend in it, if we just drop naturally to 42, I wouldn't be surprised if we just find support. And much like PBR, a stock that I played earlier who had the same exact situation, let's go to it, PBR, had that massive gap down after the dividend indicated here by this massive drop. It still had a massive rally, and it's still, actually, it went up for a few days after that. Because nothing fundamentally changes about the company just because they're paying a massive dividend. So if it does drop down here just because the dividend was paid, or the ex-dividend date happened, that doesn't mean it's going to crack support and just sell off. It probably means we're going to hold support. People are going to want to buy back into the company, and it push this thing higher, or at least keep it around wherever price it opens at. So it is a bit risky, because ZIM can easily drop by more than $2 between now and Thursday, which would mean the dividend would put the contract in the money. So that is a real risk. I'm not really too comfortable playing it, but given that it's a nice area of support and the company's looking fundamentally strong, I mean, even the support goes as far back over here, October 2021, even back in June 2021, May 2021. I think even if we do have that massive gap down, we should be all right. But it is a high risk play, and I honestly might not even bother with it. But I do think it's just one of the names that I was able to find, because it was slim pickings this week. So, but definitely take at your own risk. If you don't mind owning it, then it might be worth doing it. Because just like the one I showed you with PBR, it still had some pretty good strength even after that drop. So that's ZIM. And the last one I got for you guys is Kohl's. Back with Kohl's, are we? Yes, I just had a big stretch of selling puts on Kohl's, and then I finally got assigned, and then I was selling calls against it for a few weeks, and then got assigned there, closed a position for a profit, it was all done, and now I'm looking to get back involved with Kohl's. So, it just had earnings, and it just came down after earnings. It dropped over 7% after earnings, and then the next day, to end the week, it dropped another 4.6%. So, a pretty rough stretch the past few days. At the end last week, but there is a nice area of support here. I'm looking at the 27.50 strike. That's about $2.40 away from the current strike, which is a little less than 10%. So we'd have to drop about like 8 to 10% for us to get assigned at 27.50. The premium at 27.50 is paying $16 to $17. So let's just say 16 because that's the bid, that's the minimum. So it's paying 16 bucks, but given the price of it, I would sell 2 contracts because I like to put about 5,000 per position, like at least. At least that was kind of like my rule of thumb in the beginning, about a quarter of my account into each position. And at the time, and definitely now, a quarter of my account would be at least 5,000, which means I could take 2 contracts of Coles and get to that $5,000 collateral threshold. And if I sell 2 contracts at 16 a piece, that would be $32 in total premium, and that beats my minimum of $25. I like to get at least $25 per play. Each play is a quarter of my account, and if I put a quarter of my account into this play, I'm taking 2 contracts, and that's over $30 in premium collected. So this one's a lot better than ZIM, that's for sure, a lot safer, but it is closer to the current price. Like it's not out of the realm of possibility for Coles to drop to 27.50, but we do have a nice area of support right here. If I go to the weekly chart, we'll see what this is looking like. Nothing really holding it up beyond the recent price action. Maybe you can look over here and say, oh, it was prior resistance back in May of 2020. Maybe that's why it's being support right now, and that's very valid. But it has been tested quite a bit for a little while. You just got to hope it holds up for another 5 days. So I don't mind it there. It does have a dividend coming up too, so if we do get assigned, we'll have that dividend benefit coming to us shortly thereafter. So that's nice, and that looks like it's a 50-cent dividend. So not only will our cost basis adjust by the premium on the put, but we'd definitely be around for that X dividend, and we'd get another 50-cent benefit to our cost basis for getting 50 cents per share from a dividend. So that's very nice. I think this is a decent play, much safer than ZIM, but I like DocuSign the most. I think that's the most premium, most bang for your buck. It is a higher price stock, so that's why. But I also like the level of support that it's at, and I don't mind actually owning this company. I'd rather own DocuSign over Coles, so that's why I'm going to rank DocuSign first over those over those other 2 plays. It is more expensive, so if that's a little too expensive for you, I would definitely look at Coles. And then ZIM, of course, is a bit risky. It pays a decent premium. It is far away from the current price, but you got to be aware of that $4.75 dividend on Friday. That's going to drop the share price by that amount. And as long as we don't drop too much from now until Thursday, we should be fine. If we have like a little bit of a rally the next few days, then that's only going to make it even more safe. But if we do start to drop to begin the week, then it's looking like you'll probably get a sign. So I'm not really a big fan of this one. I'm already in a position on DocuSign. I'm probably just going to sell another put there and maybe play Coles and just leave it at that. That's what I'm looking to do. I'm going to sell calls on DocuSign, of course. I mean, I can take a look at that. Right now, let's go to DocuSign quickly. So my cost basis is $68.15. I'm looking at the calls, looking at the options chain for next week. Looks like I could go as far away as like $71. Sell 71 call, bring in $60 in premium. That's not bad. Adjust my cost basis by 60 cents. I think $71 is a pretty good spot to sell my shares to. That would be a very nice gain. That'd be over $500 in profits on just the share appreciation, never mind the call and put premium that I already received. So I think that's a good price point. I could go closer. I could go the 70 strike, bring in more premium, but I like to, there's a balance to be had. There's a balance between how much premium you want to receive up front versus the potential to sell your shares at that strike. Obviously, the further out of the money you go in the calls, the less premium you're going to get up front, but that allows you to sell your shares at a higher price. Because after all, selling calls caps your upside. That's the name of the game. That's the give and take with the wheel strategy. Selling calls, you get money for it, right? That's great. You get premium, but you're capping your upside. If this thing explodes because Elon Musk is going to buy it for $150 a share and it goes up to $150 per share, that's a monster gain. That's monster share appreciation. But if I sold a call at 71, then I'm selling it for $71 per share. Like, it caps my upside. So you want to balance that between the upside and the premium you receive on the calls. So I'm looking at the 71 strike. I think that's fair. I don't mind the premium there at all. 60, like $50 to $60. I think that's pretty good. It gives me plenty of share appreciation upside, and if I do get assigned, I'll be very happy. So that's what I'm looking for on Monday. Selling calls on DocuSign, selling another put on DocuSign, and then probably going to stick with calls and not touch ZIM personally. But we'll see what happens. If you want to know exactly what I do, follow me on Twitter. Link in the description there. Every time I make a trade or close a trade, I do post it on Twitter, so you'll know. You won't have to wait for an update video or anything. You can just follow me on Twitter and see what I do there. Otherwise, I will be back midweek with my midweek update on Wednesday. And until then, guys, that's going to do it. So thanks for watching. Let me know what you think in the comments. Maybe you have another play that I'm not seeing. I'll be very curious to see what you guys are looking at. Like the video, subscribe for more content, and as always, I'll see you all next time.